Good afternoon and welcome to the Fall 2021 Linneman Associates Capital Markets webinar presented by Linneman Associates in Real Estate Financial Modeling. This is your host, Bruce Kirsch, founder and CEO of REFM, provider of financial analysis tools and training since 2009. We're pleased to have an insightful program for everyone today, which will be presented by Dr. Peter Linneman, founder of Linneman Associates, which for those of you who do not know is a strategic and investment analysis advisory firm. We are using the GoToWebinar platform, and I just want to talk about a couple of housekeeping items before we get started, just to make sure everyone's comfortable. On the audio front, all of the participant audio is muted, meaning we cannot hear you, and that's by design, and that's going to remain the case throughout the webinar. If you're attending by computer, take just a moment to familiarize or reacquaint yourself with the control panel elements. We will be showing the slides, but if you would like to download them, please find the handout section and click on the file name and it will download. You don't need to have the slides up during the presentation because that's what we'll be showing in the viewer window, but you're welcome to keep them for future reference. As always, we're reserving 15 to 20 minutes at the end of the webinar to answer participant questions, but please feel free to send them through in real time. Just make sure that you type them in the questions box and you also hit the send button so that it comes through. If at any point you get disconnected, just reconnect the same way you did initially. If you are registered, you will automatically receive an email link to the recording about an hour after the completion of today's session. And without any further ado, I'd like to introduce the presenter, Dr. Peter Linneman, CEO of Linneman Associates. Peter, I understand you're enjoying the fall weather up in Philadelphia today.
It's a wonderful, perfect, gorgeous day here in Philadelphia. I hope it's that lovely everywhere. If every day was this good, right? So, Bruce, it's a pleasure. And obviously, I think on behalf of both of us, lest we forget, happy holiday season to everybody. If we don't encounter you before that, and hopefully everybody has a safe and enjoyable and wonderful holiday season. So let's start out with the butterfly chart. If you put that up, Bruce, we've talked about the butterfly recovery and when will it really take off. And my assessment is, particularly now that we're post September 6th with the federal unemployment top up burnt off, or that people are going to come back to work much more so. You're going to get a lot of good things happening. There will still be headwinds. There are always headwinds in an economy. You sometimes wonder what would we do if we didn't have headwinds in an economy. And there certainly are some headwinds, but there are a lot more tailwinds and great strength in the economy. So if you go to the first real slide, it's U.S. daily COVID deaths. We focus on deaths because it is the most unambiguous metric of seriousness of the pandemic as it affects the U.S. You see that we're in what effectively amounts to a fifth wave. We are on the back side of the fifth wave. It is going down, but it's still high. Make no mistake. We still have a lot of people unvaccinated, and we still have a lot of breakthrough cases as those who got early vaccinations get sick, but there does seem to be some basic improvement. It is important to remember this is just one more unpleasant factor in a world full of unpleasant factors, and we're going to have to live with it and figure out how to try to defeat it. Possibly the best news of the last month is the Pfizer and Merck announcements of treatment, especially early treatment that looks like it could get approval and appears to have high effectiveness, which is terrific news. If that continues, because the treatment part is just as important as the vaccination part. In fact, in many ways could be more important. So that's terrific news moving forward. If we go to the next slide, issues ahead. Delta is still hitting hard. You saw from the previous chart, it's still hitting hard, not just here, in many places. It's hitting hard. It's mostly hitting hard the unvaccinated. That's not to say the vaccinated aren't getting cases, and in many cases getting some symptoms, but the serious stuff seems to be hitting the unvaccinated primarily. Anybody who doubts how serious this can be should understand that the 76ers have had a number of players out due to COVID. They've been double vaccinated. These guys have no body fat. They're in the greatest shape any human being could be in. They're young, and it has laid them, several of them, low for anywhere from 2 to 5 days. And that should strike a little fear into your heart, saying, I wouldn't want to face that unvaccinated. And so something to bear in mind. Big question people are asking, we'll come back to, is will employees return to work now that the federal unemployment top-ups have expired? How long will these capacity reductions that occurred either by private action or by governmental action that have created capacity shortfalls in a number of parts of the economy, how long do they continue? And how long do the price surges continue? Having said all that, I still believe that the Roaring '20s is underway, unless we were to get another wild card thrown into it of a more virulent, more contagious version of COVID. Go to the next chart, you'll see the unemployment rate. These are the official unemployment rates. Teens on the top, and bottom being for all workers, all people in the labor force more technically. You can see how much it spiked and that it's come down. There's marker lines on each of them for average, just to help your eye do what you would otherwise do. That's what the light lines are. You can see that both are below average. Teen is at an all-time low, effectively. So the unemployment rate looks quite good. If you go to the next chart, I'll do what we've come to call apples to apples, though, employment outlook versus February 2020. The unemployment data is not as good as it first appears, and just it's this math. And by the way, it's not being manipulated. It is what it is. There were 5.8 million unemployed out of 166 million labor force. That was the 3.5% unemployment rate at the end of February 2020. Today, it's officially 5.2%. However, there are 12.2 million people receiving some form of unemployment benefit. That is to say, you claim you're unemployed, and 12.2 million people are receiving that. So if you say out of about 167 million pro forma labor force, why do I use 167? Well, absent the pandemic, the labor force would have certainly grown by 1 million or so. So I'm trying to do apples to apples. So 12.2 divided by 167 is 7.3% unemployment rate. That is to say, that would suggest something like 2 percentage point higher unemployment than the official. And of course, what's happening is a lot of people have dropped out of the labor force. You'll see that in a moment. Another way is you're going to see the unemployment insurance claims, and where they're at is they came out today, and I think they were around 260,000. That's consistent with a 6 to 7% unemployment rate based on historic data, so higher by 1 to 2% than the official. And the last way of doing it is flipping it. We have about 153 million employed today, and if you compare that to 167 million pro forma labor force, that implies about an 8.4% unemployment rate. So while it's good that the official unemployment rate is down and all of these apples to apples metrics would be down over the same time period, it's not quite as good as it looks. And there are a multitude of reasons, but if you go to the next chart, you'll see what is the primary one, which is the labor force is down by about 3 million people, which is you can see the pre-pandemic marker we have. You see how the labor force really tumbled. And then the labor force has come back a bit, but it still hasn't come back full strength. And there's no reason to believe the labor force shouldn't be back to its pre-pandemic number or higher if we fully have shaken all this off. So those 3 million are unemployed, even though technically they're not counted as unemployed. They're unemployed resources is a good way of saying it. And those resources will get brought back into the economy over time. And 3 million out of 167, again, is consistent with the kind of gap we're getting. There's some gap beyond that, but it's a way to pick it up. Go to the next chart. Where are we at in terms of real GDP? Real GDP, anytime I use real today, I'm referring to adjusted for inflation in the typical way. And we put the marker for the 2019 peak in there. It's fourth quarter 2019 is the red line peak. And just to help your eye, and you can see that we are just ever so slightly above the 2019 peak. And that's the good news, is that GDP is basically back, or another way, crudely measured aggregate demand in the economy is roughly back. And if you go to the next chart, you'll see a different variation, and that is the blue is exactly the same. It's on a shorter timeline. It picks up just pre-pandemic, the fourth quarter, so we've zoomed in. And you see the blue, and if your eye is good enough, you could see that we're just slightly ahead, as per the previous chart. The red line here is what would GDP have been if it had just kept growing at 2.5% annualized. And so what you can see is, yes, GDP is back, but we're actually about 4% below where we, quote, could have been or should have been. And that relates to we're not there. It's good news. We have a lot of runway. There's a lot of economic activity to still make up. So yes, we're back, but we're not back is another way of saying it. Go to the next chart. I referred earlier to the weekly initial unemployment insurance claims. And this is one of those charts that looks very different if we were to take the height of the pandemic out of it, because the scale you have to use goes from something like 400,000 that you've got to get it up to 7 million. So the scale really shows it. However, you can see we've come back down to where initial unemployment claims are back down. They're about 260,000, which is above where they were, but it's getting within eyeshot of that. And they have really fallen since the federal unemployment insurance top-ups have ended. Go to the next chart while we stay on employment. This is the private sector's employment. We could add government to this, but I really want to highlight the private sector. The red, again, is the peak in February 2020. Again, I'm putting it to help your eye. And you can see we're short on the private sector unemployment. So GDP is back, but private sector employment is not back, at least as of the end of October. The jobs, though, have risen by almost 1 million since the top-up expired. And remember, the top-up only expired September 6th. And you had roughly 300,000 jobs added in September after kind of languishing a bit, and then about 600,000 jobs added in October. That surprised a lot of people, didn't surprise us at all. And in fact, when the September numbers came out originally at 100,000, revised subsequently up to around 300,000, we said they're going to get revised up. It's inconsistent with everything else. People are coming back to work. And what a shock, they're coming back to work because they aren't making enough not working once that top-up expires. And we're basically talking about people on the lowest, probably 35 percentile of the wage distribution. There is a question of what about the fact that a lot of people may never come back. I think people who lost their job and were in the 65 and over age category, I think a lot of them aren't going to come back. Instead of getting a farewell lunch for their retirement somewhere in the next 2 to 3 years, they took 18 months of unemployment insurance as their farewell. And that unemployment insurance was paying them more than they were making working. So there is a shortfall of what I would call mature, lower 40 percentile wage earners. And that will last for a couple of years. Now, if you're 63 and 2 years you're going to be 65 and you're going to continue to work, well onward. The labor force participation rate of that age category had been steadily rising. It hiccuped, and it will continue to rise after this hiccup. I don't think it changed anything long term, but it did. What's the point of coming back if I only want to work 6 more months by my life plan? On the other end, people say, well, what about the dishwasher, just to pick that was making $12 an hour before the labor shortages happened that were created by the federal top-up insurance, and suddenly the dishwasher was making $16 an hour. Isn't that going to gum up the works for some time to come, even as these other workers come back? And the answer is not as much as you'd think. Don't lose sight of the fact that most people on the low end of the wage scale don't stay there all their life. Yes, there are some, but it's not the typical. I would suspect most of the people on this call at one point in their life were a grocery bagger or some entry-level job and waiter or something, and you moved onward. So when you realize that a lot of dishwashers, I was a dishwasher back in the day, but I'm not a dishwasher today. And so when that dishwasher leaves their position because they get promoted, they go back to school, they move to a better job, they go on maternity leave, whatever it may be, their replacement will get a wage closer to the norm as labor comes back. And so the high turnover in low wage positions will make it less sticky than you might think it would be at first blush. Let's go on to wealth. Go to the next chart, and you can see the red is sort of the geometric average trend of wealth over time, geometric because of percentage growth. But again, it's just there to help your eye. And you can see that real wealth on a household basis is at an all-time high. Above trend, I think that largely reflects above trend staggering amounts of money, and that money has to find a home. One of the interesting things is I actually believe you'll see higher asset prices yet to come. Doesn't mean they can't drop in between, but higher asset prices to come because we have way above normal cash holdings by households, way above normal cash holdings by corporations. We have lots of dry powder at private equity and sovereigns and so forth. And we have way above normal bank reserves. And in light of all that, when that money normalizes even a bit, it doesn't even have to normalize back to its long-term norm. But there's been so much money put in the system that any normalization of those cash positions and dry powder positions would put a lot more money chasing assets. And as it chases, and I think it'll chase assets more than goods and services. And as it does chase assets, you'll see further price appreciation, multiple expansion, cap rate contraction. So this wealth is important, and it also means households are in pretty good shape. Does that mean every household is wealthy? Young households are rarely have wealth. Again, most of those on this call, you didn't have wealth when you were young. You were among the low wealth households, but wealth rises notably over time. Whether you look at the median or the mean, it rises notably over time. If you look at the next chart and you see household debt and savings as a percent of disposable income, you can see in the red, you have a lot of capacity out there. The savings rate is still above normal, the blue line. The savings rate relative to disposable personal income is still above its norm, though it has come way down. And what that means is involuntary savings has ceased. You can take vacations again, although not everybody wants them. You can go to the ball game again. Not everybody's going. So you've got these type of factors that have brought the savings rate way down. That spike in savings you saw drove a lot of down payment capacity, as many people were able to save as much in 5 or 6 or 7 years as they saved. They saved as much in 5 or 6, 7 months, as they were able to save in 5 or 6 or 7 years. So the household's in good shape. Go to the next chart. What's happened to retail? Well, this is e-commerce, basically netting out the disintermediation of catalog sales. And you can see very upward trend and then skyrocket during the first 4 quarters of the first 5 quarters of the pandemic, and kind of flattened out from there. And in fact, what I think you're going to see is it comes back to trend. But at the time, you may remember when all that spike was happening, I said, well, brick isn't even allowed to operate. You can only buy groceries at Walmart. You're not allowed to buy non-groceries. All the malls are closed. Many retailers were closed, et cetera. Well, is it a surprise that brick sales drop? So if you go to the next chart, it's real brick sales. This is adjusting for inflation, so it's a sense of throughput. And the red is the pre-pandemic high. And you can see huge drop, and now at all-time high sales, record high sales. You'll also see, if you do the combination of the previous chart and this chart, about 6.5 out of every $7.5 are spent through brick. This doesn't include auto-related items. About 6.5 out of every $7.5 are spent through brick. Brick is still very powerful. Bad retailers got driven out of business, and so if 100 retailers were going to go out of business in the combination of 2021, 22, with a third going out each year, you basically got 95 of them going out of business in 2020, and you'll get a couple go out of business this year and a couple go out of business next year. The pandemic sped them going out of business, but they were weak in any case. So I think brick will moderate a little bit. A lot of it was pent up, but brick is not dead. Go to the next chart and you'll see the e-commerce. This is the e-commerce number put as a percent of total non-auto retail sales. And you can see that what it's doing after a spike is kind of moving towards trend. And I say to people, that's what I'd expect. That's exactly what I expect. And I use the analogy of I played basketball till I was 53 in pretty good leagues. And what if I told you my scoring average went from 8 points a game to 10 points a game when my opponent had their hands tied behind their back? It's a 25% increase in scoring, yet I don't think you'd be all that impressed because they had their hands tied behind their back. And if I then would have said to you, well, what do you think happens when you untie their hands? You'd say it'll go right back down to normal. And that's what's happening to e-commerce. It surged when the opponent's hand was tied behind their back, and it's going back to normal. And the only thing is, normal is a notably upward trend, actually in marked contrast to my scoring average as I age, which was on it was kind of a remarkably negative trend. Bruce, I might stop there just for 1 second for you.
Thank you. Yeah, we just take a quick poll to see how many folks are in the room. If we just click through on your end, we would appreciate it. Thank you. We have another 5 seconds.
All right.
All right.
Thank you. Well, that leads, it'd be interesting for us to see how many people are listening with more than one relative to, say, 2019, Bruce, as it will give some sense of back to work. And that's the next slide, return to the office, and with a question mark. And at this point, about 28% of the people, as best we can tell, are coming into the office in New York. It's closer to 45% nationally. It's much higher in the suburbs than in the core cities. It's much higher in the South than the non-South. These have risen dramatically, and people are coming back. I think they would have much more been back by now had it not been for Delta. We'll see what the rest of this year brings. I still think you're going to see people come back because it's more productive for most people at the office. And once every day somebody goes back to the office, it creates a competitive disadvantage for those who are not back at the office. People like the social interactions. They need it to be present for a lot of the office politics. And while it's true that working from home saves commute time, and that is productive, I think the thing people forget is that to effectively work from home requires self-discipline, namely I actually really work, self-motivation, which means I'll really work, and a conducive work environment. Now, if you said what % of the American workforce has high self-discipline, is very self-motivated, and has a conducive work environment, it's not many. And while it might be a fair portion of the people on this call, it's not a large portion of the total workforce. So I do believe still people will come back, and we're seeing them come. How about hotels? Go to the next. Domestic travel has made a nice rebound. It stumbles a little as Delta set in, but has made a nice rebound. My guess is, unless we see something strange, we're going to have a good travel period relatively on a relative basis. The Thanksgiving through the week after New Year's should be quite good. Things domestically are better than you'd think, given there's not much international, because we're not going abroad. So the ones who would have gone abroad are doing stuff in the country. And that's kind of happening around the world, is that this industry is doing better than they would have thought in the hotel side, less so in the air travel side, because everybody's doing things domestically rather than abroad. People like the social interaction, the experiences of leisure. Businesses are finding there is a face-to-face competitive advantage of interaction. International opened the beginning of this month, and you'll see more and more people come in. Labor shortages at the lower end are still an impediment to giving the full experience, however, in this sector, but it's coming back. Go to the next is multifamily snapshot. Urban core was weak going into the pandemic in that there had been an oversupply, depended on which market by how much, but there had been an oversupply. The pandemic really hit the urban core demand side very hard, just as a lot of supply was coming online. But that all seems to have bottomed around February of this year. And since then, there's been a very strong recovery, even though people aren't going back to work. And I was talking to Anoop Dave, a very good friend and partner on some things. And Anoop pointed out that just like a lot of my faculty colleagues loved universities, especially when students were not around, people like urban environments. They just don't like working. So that the urban environment is still very attractive, maybe even more attractive if you don't have to work, because you have more time to do all the things that an urban environment offers you. So the urban cores are strengthening and largely rebounded. Suburbs are doing well. Suburbs were strong going into the pandemic and have only gotten much stronger. The involuntary savings that I mentioned and COVID inheritances. What I mean by COVID inheritance, some grandmother or grandfather died at the age of 75. They were otherwise going to live until 82. They died 7 years early. So their inheritors got their inheritance 7 years earlier. How does that affect home ownership? It affects home ownership because imagine somebody with 200,000 life savings dying 7 years early. Their 2 children and 3 grandchildren each get 40,000 7 years earlier than they expected. And in so doing, have money to make a down payment. And you can see that surge. Now, single family has stayed solid, but much as we said, when the deaths slow, so you don't have as much early inheritance, and as spending goes back towards normal, this abnormal down payment capacity goes away, and you'll get a more normal looking single family market. Demographics for multifamily are solid looking forward. They're not unbelievably great, but they're solid. You have a fundamental shortfall of supply for multifamily, and you have an even larger fundamental shortfall of single family. So housing is fundamentally undersupplied. There's a limited supply outlook in the near term of multifamily. So I wrote that it was a golden era for multifamily, and I think we talked about it early this year. I think it's still a golden era. Yes, cap rates have come down, but there's so much money in the system that yet to come out and chase assets that you still have probably a 10% further compression of cap rates that will occur over the coming years. So it may not be quite as golden as at the beginning of the year, but it's still golden. Go to warehouse. Strong demand continues because to sell things online take about 3 times the amount of warehouse space as if you sold them through a store. And that even though supply continues to grow, it isn't growing as fast as that implies versus that trajectory of online sales. It's now an institutional investment class. There's a lot of money flowing into it, so strong pricing continues. So we take the RCA, Real Capital Analytics, private real estate values. These are real, adjusted for inflation. You can see for the office, industrial, and retail. Industrial has been the strongest, office kind of stumbling around in real terms, while retail is down, although it appears to have found bottom. And then if you go to the next chart, we have multifamily and hotel comparable. Multifamily is basically at an all-time high in real terms, and hotel rooms have made a big comeback as the pandemic has gotten a little farther in the rearview mirror. Go to the next. These are for REITs only because it's transparent. And what we basically have is pre-pandemic to today cap rates. And you can see on all property categories, cap rates are down. Most notably, the cap rate's down on multifamily and especially industrial. The others are down a bit across the board, not for every property itself, but by all the property categories. And I think you're going to see more of this as we come back over time. Again, not necessarily every session, but this is the secular pattern we will see, and it's because of the money. Go to the next chart. I would like to remind people that if you think about valuation as discounted cash flows, the worst cash flows are already behind us. So that alone makes property values rise. And discount rates are falling the more certainty we get that the world isn't coming to an end. That raises values. These massive liquidity injections will cause a lot of money to chase assets. And as I noted before, we've got record amounts of cash on hand and record amounts of dry powder and dry debt capacity. That's not rampant greed. You would expect cash holdings to be way below normal if people thought trees grew to the sky because I got to invest. And you would expect to see not much dry powder if people thought trees were growing to the sky and I can't lose. And loans would be at an all-time high. So the markers are not that greed is rampant. Yes, fear is not where it was in March, April, May, June of 2020, but you still have so much money out there. So I think you still get notable value rises. And as I said, cap rates will continue this decline. Go to the next, a couple of bigger pictures. One is the federal debt per household. And you can see there's a pretty identifiable pattern of up, up, up. And that's federal debt per household. So everybody on average has about $220,000 your household owes in federal debt. However, and do one more, this breaks it into different time periods of the federal budget from an outlay point of view in the red and a revenue point of view in the blue. And you can see the gap between the red and the blue just keeps growing. This is another way of saying it is we are passing on the bill to our future selves. People say you're passing on your children and grandchildren, and at one level that's true, but you're also just passing it on to your future self. If you're 25 years old, you're just borrowing from your 40-year-old self to fund things today, or your 60-year-old self, or your 70-year-old self. Don't even think about it as your children and grandchildren. Just think of your future self. You're borrowing from your future to pay for it now. And given the trajectory of real income over time, it's not stupid to run deficits. Namely, I should be borrowing from my future self because my future self is wealthier. And why have this live within your means today if my means tomorrow allow me to live better today and be able to afford it tomorrow? Now, I think the gap has gotten a bit large, but you can go to the next chart and you kind of put this in historical perspective. This is federal debt as a percent of GDP, and you can see the Revolutionary War, you can see the War of 1812, you see the Civil War, see World War I, you see World War II. You then you get a bit of Vietnam, and then you get today. And yes, we've had the war on terror, the wars on terror for the last 20 years. That's part of it. But also, as part of it has been, we want guns and butter. So you can get a sense of just how large it is. Next chart is, it's not how big the debt is. We're a very rich country. $5 trillion in new debt for anything. It doesn't matter for what. I originally did this in the context of COVID expenditures. $5 trillion is less than 4% of our current wealth. It's only about 0.6% of the net present value of U.S. GDP. That is our future selves. The annual interest cost is only about 50 billion, which is 25 bips of GDP a year. And it's only about 1.2%. That interest outlay is only about 1.2% of the 2019 federal budget. So I'm not trying to say 50 billion a year isn't a lot of money or 5 trillion isn't a lot of money. It is. But to the extent we're alleviating generational suffering, to the extent we're coming up with valuable medicines, to the extent we're providing true infrastructure that will serve our future selves, that's great. On the other hand, so the question isn't can we afford it? We of course can afford it. We're rich. The question is, are we getting value for our money? And the one thing I would implore you is stop asking, can we afford it? And instead go line by line by line by line of government spending and say, are we getting our money's worth? And this Keynesian notion that somehow all government spending is equal is just silly. It's not. All government spending isn't equal. And some government spending is a net efficiency gain and some is a net efficiency loss. And the efficiency loss are drags on the economy and the efficiency gains are gains on the economy. And I use the example, suppose we spent $100 billion rounding up the most productive third of our population and then executing them. Well, it's $100 billion. Is that going to stimulate the economy? In a Keynesian model, that $100 billion is stimulating the economy. And you know that can't be true. On the other hand, we spend $100 billion and we find the way to cure obesity. That would more than be wonderful, right? And so it's all a matter of, are we getting our money's worth? And there's no single answer. It's answered one at a time. One other thing I'd point out is that although total federal debt is about 28 trillion, our GDP is about 21 trillion. Even though total U.S. federal debt is about 28 trillion, we only owe about 7 trillion to non-U.S. parties. Out of the 28 trillion, we only owe 7 trillion to somebody, quote, other than ourselves. We owe U.S. citizens 9 trillion. But by the way, that says some U.S. citizens, no, it means all U.S. citizens, to the extent they pay taxes, owe some U.S. citizens 9 trillion. So that money stays within the country. And if you say, well, what's the gap between the 28 trillion and this 16 trillion, the 7 and the 9? It's debt held by the federal government, either government agencies or held by the Federal Reserve. Well, that's intercompany debt. So of the 28 trillion, 12 is intra-company debt. So it's not real debt. It's just left hand owes right hand. And then of the remaining 16, only 7 trillion is owed to outsiders. The rest we owe to ourselves. So to pay it, we'd impose a tax on ourselves to give it to ourselves. Now, I'm not saying it's neutral as to who would pay and who to get, though it's more neutral than you might first think because it tends to be disproportionately held by higher income, and it would tend to be paid disproportionately by higher income given our tax situation. And in fact, even go to the next chart, even though you can see federal debt rising, if you go to the next chart and you see federal debt outstanding, we break it into categories. And the blue is this total outstanding. That's the 28 trillion. You can see how it rises. You can see the big jump as we enter into the COVID. And you can see the net. The difference between the yellow and the blue is debt held by government agencies, most notably the Social Security Administration, and a technicality owns U.S. government debt. If you net out that, and you net out what's held by the Fed, you get the red line, which we refer to as net. And that's the 16 I was referring to. And while it's risen over time, its increase is not nearly as dramatic, which is to say, the real rise in our debt has been what we owe to ourselves. And so the picture is not necessarily wonderful, but it's not as bad as it first appears. Bruce, I'm going to pick up here real quick and we'll go to the money supply. You can see, as we've talked about, the money supply has risen a lot. That's kind of like a rocket ship up. Go to the next. Inflation remains high. Almost all of the inflation that's occurring today is either anomalous, namely a price was at a bizarrely low level in 2020 due to the shutdown and has gone back to normal. Think of hotel rooms in that regard, or airfares, or is created by supply chain issues, which are really not supply chain issues, they're capacity issues. As businesses reduce capacity, as government restricted activity. And one of the examples I give is a Samsung factory outside of Hanoi was shut by the government for something like 6 months. Well, how many vendors went out of business that were supplying that Samsung factory with components because they had no revenue? They went out of business, and they weren't in countries that had PPP, or they weren't in sectors that had bailouts. Think of elective surgery. In the United States, we basically couldn't get elective surgery for 4 months. How many vendors went out of business because they had no revenue, because there was no elective surgery? And you say, yeah, but didn't they get PPP or some other version? Not if they were, say, from Peru, where there were no such bailouts. And you start putting that in, you put on top of that all the capacity cutbacks that occurred voluntary. That's what's happening to prices. And so if you go to the next slide, it says inflation status. What you've got is a recovered GDP, kind of overall demand. So we've got demand hitting new levels, slightly higher than 2019, and capacity is lower than it was in 2019, and you get big price spikes. And used cars, for example, were anomalous, and there's a shortage of cars. They're 20% of all the CPI increase in the middle of 2021. Don't confuse high prices with rising prices. Children are short but growing. NBA players are tall but they're not growing. And so what you have, think of lumber in our world. Lumber went from something like $340 to $1,800 in a matter of months in 2020. Since then, it's gone from $1,800 down to about $520. So it's still way above where it was pre-pandemic. There are still capacity issues, but as capacity got brought back online, it has fallen. So it's high, but falling. Falling is deflationary. And I think you're likely to see that happening. Capacity is slowly returning. You want high prices for these areas with capacity shortfalls. Why? It sends a signal that capacity is needed. If they were to mute and say, well, you can't let these price increases occur, which I actually worry about politically. If they say price increases are forbidden, you have no signal to bring back capacity there. And if you don't bring back capacity there, this problem will continue long into the future. The higher the prices go, the faster the capacity problems solve themselves. And in an odd way, it's like a fever. There's good news of the fever going up, and it will break, and the patient will get healthier. And yes, you might be able to do things to speed it along, but it is actually a good thing happening. Go to the next chart about the monetary base. You can see the monetary base was about 800 billion prior to QE1, excuse me, 2 and 3. You saw the base then reduced a bit, and then with QE infinity has gone out of sight. And that's the weight of money I keep talking about. You can see on the next chart, endless bank reserves. Those are monies that can be lent. And go to the next chart. So interest rates, I think, generally stay low because of the weight of money. Even when the Fed stops buying, when the taper is completed, yes, the U.S. government won't be buying. That reduces the number of demanders. But there's so much money out there that even though the rate will rise a bit, as it did when the Fed stopped buying with QE3, it won't go very high because there's so much money out there. Again, cash holdings, et cetera, at record levels. And the next thing I'd say is go to the Linneman index. This is outstanding commercial and multifamily mortgages relative to the size of the economy. It has not collapsed. That's why real estate values have not collapsed. It did not collapse because the Fed flooded the market with liquidity. That liquidity has not come out. And as it does, this will rise. And when it rises, you'll see cap rates go down. And then the next two charts simply break that down, Bruce. One shows the multifamily outstanding. The other breaks it down. The last chart breaks it to commercial mortgages outstanding, and both are holding solid. We have just posted online again a reprint of research that Matt Lariva of SCP and I did, doing some building on work I had done way back and on what drives cap rates. Cap rates are primarily driven by the weight of money, not by interest rates. The intellectual experiment is simple. If there's twice as much money chasing real estate a year from now as there is today, what happens to cap rates? And everybody would say, well, of course, cap rates will go way down. You could argue about how much they go down, but they go way down. And I'd say, and you didn't ask me what were interest rates before you answered. So you understand what's going on, and all our research does is show it. Bruce, with that, I'll stop, and we have like 5-10 minutes for questions.
Great. Thank you so much, Peter. As always, very insightful. And I think it's getting the wheels turning in everybody's head about what they should be thinking about for 2022. Several folks wrote in about when do you think the massive excess liquidity is going to start to burn off and we'll start to see more reasonable asset prices, including for real estate?
By reasonable, I'm assuming the people are suggesting lower pricing. I think you're at a new norm. Now, the new, that's why some people may remember I wrote about my grandmother Linneman, a true story. I wrote about my grandmother Linneman when I was a hotshot PhD student at the University of Chicago, and my immigrant grandmother said, well, surely the price of a loaf of bread can't stay this high forever. And I said, no, it's even going to go higher. She says, how's that possible? And I said, Grandma, there's so much money trying to buy bread. There's going to even be more money trying to buy it tomorrow. Well, the price of bread never went back down. Now, it may have gone down temporarily because there was a sale, right? Or there was a surplus of wheat at one point in time. But systemically, the price of bread just kept kind of going in the weight of money. It didn't rise as fast as it did in the 70s because the weight of money didn't grow as fast, but they never reduced the weight of money. This money that's in the system, not all of it's going to come out, but it keeps that weight is there to keep the pricing where it's at. Let's be honest. Why did the Fed inject all this money with QE 1, 2, and 3 and QE infinity? They did it to support asset prices. That was the overt reason, was to support asset prices. That was what they wanted to achieve. They thought that might stimulate the economy. I don't think it stimulated the economy, but it certainly held the economy from collapsing. But it's designed to hold up asset prices. They're not going to revert. They're not going to revert, although you could have swings from greed to fear that temporarily reverted. Think of the stock market. We had where panic set in, stock market goes down, and then, but what happens if you come back 6 months later or a year later or 2 years later, you're back up again, and that's the weight of money.
Thank you. One of the comments you had on your industrial outlook slide was that it's now an institutional asset class. And we've had a couple of participants write in about the massive supply that's coming online and plan to come online. And they want to know if you think that there's demand to justify this massive wave of new ground up development on the industrial front.
I kept asking myself that, and my answer to that has evolved over the last 3 years as I came to better understand how much more warehouse space is needed for online sales than brick sales. And your intuition is initially 1-to-1, whether it occurs in a brick or occurs online. You need a foot of warehouse space, let's say. Well, that's not true. You need about 3 feet of warehouse space if it occurs online and about 1 if it occurs in brick. That's that 3-to-1 factor. When you do the math on the trend, not on the spike in online sales, but when you do some very simple math on, okay, here's the trend, therefore that's how much retail sales will probably increase over the next 5 years. And if you then allocate that between brick, which needs more warehouse for their increased sales, and you do the same thing for online, I come up with a number like you need 4.5% a year on the trended basis. If the factor stays 3-to-1, you need around 4.5% new supply each year to stay up with the demand. And it's all around this 3-to-1 factor and the positive trend in online percent sales and the overall growth in real retail sales. You combine those three. Well, we're not producing 4.5% new warehouse space. So what's been happening is 4.5% increase in demand, 2% increase in supply, rent goes up, occupancy goes up. That sends a signal in develop 2.5% of the stock. But demand has grown by 4.5%, supply grew by 2.5%. Not as bad an imbalance as the previous year, but it worsens the imbalance. Hit repeat. And until we get around maybe 4% new supply a year, which we're not close to in most markets, I think this continues. I just think it continues. So fundamentally, it has good fundamentals, and the only footnote to that, there are 2 footnotes. One is a lot of those online sales aren't profitable. So if they were ever to have to face a day of reckoning on those sales have to be profitable, whether they're dedicated online retailers or integrated retailers, you would see the amount going through online going down. And the second is every day somebody wakes up at Amazon trying to get the 3-to-1 factor down to 2.5. And then if they get it down to 2.5, they're going to try to get it down to 2x. And so that says supply on the one side is trying to catch up with a 3-to-1 phenomena. And that's going to take time.
Thank you. We'll do one more. Looking back on 2019, when multifamily vacancies were low, and they've gotten even lower since then, and rents have grown, how much lower can they get? And is there a catalyst for taking them there? Or in retrospect, are we going to look back at 2019 and say, well, that was as good as it got?
Oh, I think you're going to get a little better because there was a slowdown of supply in 2020. new starts when I say supply, right? Because of COVID and construction pauses and construction lending pauses and equity belief in basically the last 9 months of 2020, there was a shortage of that activity. And that means, just play out the pipeline a little bit. That means they're going to get a little better. The rent and occupancy are going to get fundamentally a little better, reflective of that kind of shortfall phenomena. You've got it added to by the fact that some of these supply chain issues and cost inflation issues. But I think you're around you're going to look back historically and say, well, that was a pretty good time. But I don't think you go the other direction and say, oh my God, what a massive excess we've got. I think Freddie and Fannie being there as, quote, the takeout with known underwriting is not perfect discipline on the development market, but it's pretty good discipline on the development market. Bruce, I might say, if I could, just in wrapping up again, happy holidays to everyone, and I hope you have a wonderful season, and I hope you have a safe holiday season, and we'll talk to you in the new year. And I would encourage all of you to think of those less fortunate. There's no shortage of wonderful charities doing wonderful things. And while for many of us this has actually been quite a wonderful year economically, that is not true for people everywhere, including in this country, but certainly outside this country. And if you feel charitably inclined but don't know something that might need it, take a look at Save a Mind, Sam Elimu Education. The link is on our website, but there are many other wonderful things that you could give, and I would encourage you to do so while you're thinking about it. Bruce, with that, thank you.
Great. Thank you so much, Peter. Well put. And just as a reminder, if you're registered, you will automatically receive an email link to the recording of the webinar in about an hour. So with that, thank you again for joining. Be safe, have a happy holiday season, and we will see you back next quarter. Thanks again, Peter.
Thank you. Bye-bye.